Happy holidays, everyone. This week, I'm going to focus on the 2026 retail real estate outlook. I recently attended the ICSC Retail Conference in New York City, and based on the feedback from investors, sentiment remains strong. That said, in 2025, retail space demand did taper, with space absorption falling into modestly negative territory. Despite this, the overall retail vacancy rate remains range-bound near 5%, supporting rent growth in the 1% range. Now, much of the slackening of momentum is likely due to broad-based economic uncertainty, largely driven by elevated tariffs. That caused retailers to adopt more cautious expansion plans over the last year. Still, numerous metros are set to close out 2025 with vacancy rates below 4%. In looking at the various subcategories of retail, vacancy rates at open-air centers have converged into a tight band ranging between 4.5% and 4.7%. The outlier driving overall retail vacancies higher has been shopping malls, which have a vacancy rate north of 9%. Historically, unanchored centers have tended to have a higher vacancy rate than anchored properties, but since 2020, vacancy rates have converged. This likely reflects the very limited pace of retail construction over the past 17 years. In the trailing 12 months through the third quarter of 2025, only about 10 million square feet of multi-tenant retail space was constructed, the lowest pace of completion since 2012. So while retailers have been more cautious in taking down additional space, the limited pace of construction has helped to restrain vacancy rates, and that trend is likely to carry into 2026. Retail construction is expected to total a record low 30 million square feet in 2026, and more than 70% will likely be single-tenant space, in alignment with the trend over the last 8 years. As a result, even tepid space demand in the coming year will keep vacancy rates low. Now, there has recently been considerable commentary about elevated consumer debt, with many suggesting that retail sales could falter and restrain retailer expansion. Auto debt has reached a record $1.7 trillion, credit card debt has reached a record $1.2 trillion, and total household debt has risen to a record $18.5 trillion. And on the surface, those are really big numbers. But at the same time, investors need to consider that wages have been growing at a healthy pace as well. When measured as a percentage of income, auto debt is just 5.5%, down from the 10-year average of 5.9%. Credit card debt at 4.1% is just modestly higher than the 10-year average of 3.9%, and credit card delinquency rates are just 3% below their 25-year average of 3.4%. And total household debt is just 61.3%, also below the 10-year average of 64%. So while total debt in absolute numbers is high, when rising income levels are factored in, the debt load isn't as severe as it appears on the surface. At the same time, total savings, including money market funds, reached a record $25.4 trillion in the third quarter of 2025, up 4% from a year prior. That implies that consumers, in net, are not under duress, and that the retail sector remains well positioned to outperform in 2026. From an investment standpoint, although aggregate vacancy rates may tick up nominally in 2026 and rent growth may be modest, retail property investors remain optimistic. Overall, retail cap rates have stabilized in the 6.8% range, with single-tenant retail cap rates running in the low 6% band and average multi-tenant retail cap rates running near 7%. Total retail investment activity reiterates the investor optimism, with a 12% gain in retail property transactions compared to the 2014 to 2019 average, and it appears that momentum will carry into 2026. So while tariff-driven uncertainty may weigh on retailer expansion plans and some consumers remain under financial pressure, the retail real estate sector remains well positioned for growth in 2026. Naturally, with federal policies remaining unpredictable, new headwinds could emerge, which is why investors always need to keep their eyes on the horizon.